Hello, everybody. Thank you for joining me today. My name is Tim Travis, CEO of TNT Capital Management, and we're going to talk about the investing climate going into the second half of the year. It's been a tumultuous 2022. We're going to talk about specific investment ideas and strategies you can use to take advantage of this environment. Just a little background, we're a registered investment advisory firm. We've been in business about 11 years. I've been in the industry over 20 now, and we're located in Southern California, Orange County. So let's go ahead and get started. Hopefully this is of some value for you. So of course, there's risk in all investing. Options are not suitable for all investors, and past performance is not indicative of future results. Here's a great quote from Warren Buffett. He says, "I would consider a year in which we declined 15% and the Dow declined 30% to be much superior to a year when both we and the average advanced 20%. Over periods of time, there are going to be good and bad years. There's nothing to be gained by getting enthused or depressed about the sequence in which they occur." So we're going to kind of teach you some tools that can reduce, losses in a nasty year like this. I mean, like Buffett says, I mean, if you're down 15% and the market's down 30%, you're way ahead of the game, and it's going to be way easier, to get back to even and get back to profitable again. It's a lot harder to do for most folks because they're only investing in just stocks and bonds. So we'll kind of widen the horizon of tools. So looking at the markets, as of July 5th, the S&P is down about 20%, the Nasdaq's down about 30%, the Russell small cap's down about 30%. Valuations have come down quite a bit. The Schiller PE, inflation adjusted, is down to 29, so still a bit higher than the 20-year average, but I mean, that number was close to 40 when we started this year. Inflation's running around 8 or 9%. The reality figures are probably quite a bit worse than the government figures. Treasury bond yields have doubled since the start of the year, but they have pulled back quite a bit. So they're at 2.89% now. But they are down quite a bit from the highs. Junk bonds are yielding 8.5%. So that's up from about 5% to start the year. So there's a lot more attractive yields there now than there has been in quite some time. Still could potentially see some widening spreads there. So, but I think it's much more attractive. A 1% increase in interest rates would reduce Treasury bond prices by roughly 7%. So that's just kind of the general rule of thumb. And the interesting dynamic this year is that you have bonds that are getting destroyed. So you have equities down big and bonds. So bonds aren't hedging whatsoever, and you got a lot of these bond funds down 15, 20, 25%, which is awful. And so that means the 60-40, the 70-30 target portfolios, they're all getting killed. How do things look moving forward? So basically, a stock is simply a fractional share of a business. Every business or stock has an intrinsic value. The intrinsic value of a business generally changes at a much slower rate than the price of a publicly traded stock can change. Over time, the intrinsic value of a business and the stock market value of a business converge. It could take 90 days, it could take 3 years. The timing is always kind of the trickiest part. And by buying the business at a substantial discount to intrinsic value, you are thereby creating an adequate margin of safety. So that's really what this is all about. This is the Benjamin Graham framework for value investing. So two of my favorite investors ever, Charlie Munger and Benjamin Graham. Charlie Munger says money is buying and selling, but in the waiting. So patience. Everyone's trying to get rich quick. Just being in the market for enough time is critical. Starting early, and not panicking. The intelligent investor is a realist who sells to optimists and buys from pessimists. So think about that. Last October, November, people were paying $60,000 for a Bitcoin. The IPO markets were insane. The SPAC markets were just going crazy. People were doing the NFTs. A lot of people had no concept of what even they were buying. It's just they were looking at the stock market like a video game. And now, many of these investments and stocks are down 70, 80, 90%. and people have been devastated. I mean, a lot of them are down a lot worse than the overall market. So, now pessimism is extreme, and that creates fertile grounds for investing. It doesn't mean that the market can't go down a bit more. Of course, it can. But the reality is that there's a lot more attractive ideas than there's been in quite some time now. So, being greedy when others are fearful is still a good idea. So let's take a look at one. So Citigroup, on the stock trading at 46.87. The tangible book value, which is kind of the closest proxy to liquidation value, is 79.74. So it's trading at less than 60% of tangible book. Normalized earnings power is about $8 per share. That's just a conservative 10% return on tangible equity. Longer term, within the next 3 years, let's say, I think that number could go 13% ROTE. So that obviously will help earnings, as will stock buybacks done cheaply, since the stock's trading so cheap. The normalized earnings yield, which is the inverse of the price to earnings ratio, is 17.06%, and the dividend yield is a very healthy 4.35%. So we think Citigroup's conservatively worth about $80. So that would be 70% upside plus the dividend. And, we feel this is a very high conviction investment. The 52-week high is $80. And I mean, look, even if there's a recession, Citigroup's going to remain profitable in our estimation. I don't see any scenario whatsoever that they're likely to start taking losses by any means. So they're going to be able to keep growing that book value per share. Stock buybacks are hugely accretive at these levels. So how do we take advantage of it? Well, naturally, we'll buy the stock. So let's say we buy 1,000 shares of Citi. Our 2 to 3 year target price is 80. If the stock hits 80, that means we'll have made 33 grand roughly on our $47,000 investment, plus a dividend, which is once again 4.35%. The net on cost return would be about 70%. So if that takes a year, 2 years, 3 years, whatever it is, that's a heck of an annualized return. And as I said, I just don't see a scenario where this stock isn't meaningfully higher, over time. It's just a reflection of very nasty pessimism. People are just thinking the worst. They think it's 2008, but they don't realize that the banks have double the capital, double the liquidity. It's just totally different underwriting. It's just, history doesn't repeat it, but it does rhyme. And it's very different though for the banks this time around. Now, in addition to just buying stocks and bonds, we'll also use options. So statistically, there's some inherent advantages towards selling options, as far as the majority of them expire worthless that are held to expiration. We use options as a tool to add that element of timing, which you don't have when you're just buying stocks. We use them for the purposes of generating income, reducing risk, lowering our cost basis, and selling at prices that we are comfortable selling at, not speculation. So with the stock at 46.87, we can sell a January 23 $45 put for $4.10. Each option contract represents 100 shares, so that's $410 of premium. The maximum risk is $4,090. Now think of options as kind of a flip of a coin, heads or tails. There's two things that can happen. So just to make it simple, I mean, that's all there is. Heads. If Citi expires above 45 in 200 days, you will collect the full target profit of $410 or 10% on the maximum risk. This equates to 18.5% annualized. So very healthy return in half a year. Tails, if Citigroup expires below 45, you will own 100 shares at a break even of $40.90 and will have all the upside or downside from there. Therefore, the stock could go down 12.7% by expiration before you lose a penny. So remember that Buffett quote we kind of started the presentation off with, if he'd love to be down 15% if the market's down 30. Well, I mean, this is a good way to do it, right? If Citigroup's down 30%, you're down, 17%? So it's a heck of a lot better than being down 30. And I mean, obviously, I think we'll make money on this. But it's a more conservative strategy than just owning the stock outright. And sometimes, when stocks stay low for longer, it's a great way to buy on the cheap. Covered calls. Now, Citigroup is so undervalued, I wouldn't necessarily recommend selling calls at this point, but I want to show you how it works. So you buy 100 shares, you sell January 23 $60 call for 85 cents or $85 total. The maximum risk is 4,602. So once again, heads or tails? Heads. If Citigroup expires above 60 in 200 days, you will collect the full target profit on the calls of $85, which is 1.85% on the maximum risk. Plus, you will have made $1,313 on the stock appreciating from 46.87. Your shares will be exercised and you will settle in cash. This equates to 30.3% return or 56% annualized plus dividends. So obviously a stellar return. And as we said, 60 is far short of our actual target price. So I think that's a very realistic scenario. Tails, if Citigroup's below 60, you'll end up owning 100 shares still at a break even of 46.02. And you'll all the upside or downside from there. So all you're doing is kind of decreasing risk. You're giving up a little bit of upside for more income. That's kind of the trade-off. Now let's talk about another stock, Meta Platforms Inc. So this is the old Facebook, if it doesn't look familiar to you. I'm not crazy about the new name. It's kind of confusing. But anyways, this is a stock that's just been hammered. So it has a 52-week high of $384. And now it's trading at 160. Okay, so the forward priced earnings ratio is 13.5. So this is Facebook, Instagram, WhatsApp. I mean, they have been growing revenues, growing earnings. They definitely were a lockdown pandemic beneficiary. So, I expect revenue growth to slow down quite a bit. They're spending a lot of money, which is kind of scaring people. But to put it into context, that's about half the historical PE. So, you got to ask yourself, is that an opportunity? And this is not like a no growth business. This is a very high return on equity, return on invested capital business that traditionally trades for a much higher multiple. I mean, that's half the multiple of Coca-Cola, for instance. Excuse me. On a enterprise value to EBITDA basis, you can once again see that it's about half of its historical average, and 7.2 is really cheap once again for this business. The balance sheet is pristine. They have 29 billion of net cash minus debt, cash and investments, that is. The normalized earnings yield, which is the inverse of the PE, is 7.4%. So, I mean, think you get that right away in terms of an earnings yield. If you were to own the whole business hypothetically and they paid out all the earnings as cash, that would be your yield on it. And you've got growth from there. So if they grow 10%, 15%, 20% from there, and then you get revalued higher, you can make a heck of a lot of money. The intrinsic value, we think conservatively it's worth about $250, which is about 56% upside. So there's a lot of opportunities in tech. And it's not, you can buy profitable tech companies. I mean, Google's pretty cheap too. We can talk about that another time. So let's go to the next one, Ally Financial. Stock's trading at 34.20, down from its 52-week high of 56.28. Tangible book value is 37.11. That's, so it's trading at about 90% of tangible book. Normalized earnings power is 560, which is about 15% return on tangible equity. Now, they over earned last year. So they earned like $7 or $8. And the reality is they benefited massively from higher used car prices because there was so few new cars being built that it raised the prices on the old ones, and people are driving more, not using as much public transport. But this is another company that even if there's a recession, they're still going to make a ton of money. They're going to stay profitable. They're going to grow tangible book value. The dividend yield is 3.5%, and the normalized earnings yield 16.37%. Once again, these are stellar numbers. Think of yourself as owning the whole business. And this is a company that in my opinion, will absolutely grow their earnings. Intrinsic value, conservatively 50, so that's about 50% upside. And then, once again, I mean, that's a discount to where its 52-week high is. So these aren't heroic assumptions. So let's go one more stock, LendingClub. So this is Fintech. It gets lumped in with companies like Upstart and Affirm, but it's different. They've got a great product. People are able to buy, people are able to get loans and buy loans, provide credit for loans. And so it's a phenomenal platform for that. But then what changed the business was they bought a bank. So this bank, obviously has billions of dollars in deposits, and they went from having to fund their business with, maybe like 7, 8, 9, 10% unsecured debt yields, to paying 1.5%, deposit yields. So the net interest margin expanded dramatically because a lot of these loans that they're buying or putting on their balance sheet or selling are 15%, 18% after credit losses historically. So huge spreads. This isn't your normal bank either. So tangible book value is 702, price to tangible books 1.7. I can't imagine it. They're growing like gangbusters, so it's not going to trade cheaply like the others, in my opinion. Forward PE is only 7.4, so a normalized earnings yield is 13.5%. We think the stock's worth conservatively 25. I mean, it's one that I think has immense long-term potential. I love this stock long-term. 52-week high was 49.21. So once again, conservative estimate. I'm just going to point out how you can use options on this one too, because it is a unique one for that. You can sell one January $8 put for 90 cents or $90 total. The maximum risk on this trade is $710. So if LendingClub expires above 8 in 200 days, you will collect the full target profit of $90, which is 12.7% on the maximum risk. This equates to 23.4% annualized. So just an absolutely fabulous return. And here's the great part. So if the worst case scenario occurs and LendingClub expires below 8, you're going to end up owning 100 shares at a break even of $7.10, and you'll have all the upside or downside from there. Therefore, the stock could go down 40% by expiration before you'd lose a penny. So, think once again to that Buffett quote. These are tools. The options are tools that you can add, to your arsenal and really enhance your odds of success. In an environment where bonds are losing money and stocks are losing money, these tools have really helped us. They've helped our clients, and it's I think the benefit will keep showing dramatically. And there's so much volatility. There's a lot you can do. So that really concludes the major part of the presentation. You can reach me directly if you have any questions. My number is 805-886-8140. And our website is www.ttvalueinvesting.com. And we provide investment advice, wealth management. We're institutional advisors with TD Ameritrade. Our most popular program is a managed account. So it's a lot to do options. It definitely adds complexity, and a lot of firms won't do it because it does take time. It takes being in there and focusing on that, and that's what we do.